What's up guys, this is Nick and I'm coming out with another video on how you can make some changes to improve your trading. I'm going to look today at why you should size up on your prop firm valuations. Maybe this is going to be controversial, maybe not. I've seen people talking about similar topics, but it does kind of go against the grain of what a lot of people suggest you do. If you're new here, make sure you subscribe and check out the other videos on my channel. I share a lot of information on how you can improve your trading performance, working on psychology, and I also share my journey as to how I got funded 3 times in the space of a few months. If you're also interested in getting funded, check out the link in the description that takes you to my website. That gives you the largest discount I personally can get from Bullnox. I update that every time I get a new deal through. So even if you're watching this in 6 months' time, you don't have to worry about a discount code because it will be on the site. So check that out. And let's jump into this. And to start off with, I want to talk about why trade small. And I'm going to go into these in a little bit more detail, but these are a few reasons I've heard people use as to why when you pay for an evaluation account, you should trade with pretty small size. Number one is you're less likely to fail. Kind of. We're going to debunk that fully in a second. Number two is you shouldn't gamble because if you get funded, you'll blow your account anyway. And number three, there's no rush. Prove you're profitable. Now, the big problem, I think, with all of these statements is a lot of them are recycled through chat rooms, through traders who have not yet become successful, and they share them as common knowledge. The reason this is a problem, and it's a massive problem in our industry anyway, is you end up getting advice that sounds good. It sounds like it makes sense, but you're getting it from traders who are not successful, who are not funded, or who have got funded once but have failed 10 times and are now sharing, oh, if you do this, you get funded, and then 2 weeks later they blow their account. Unfortunately, there are a lot of traders out there who feel like they know a lot, but do not actually have successful knowledge. Right? They know a lot about trading, but they don't know how to be successful. But because they know a lot about trading, they share a lot, and it's pretty bad advice. So I'm going to go through and debunk each of these now. First of all, saying you're less likely to fail, this is actually completely backwards. If you are somebody who has failed to make money in the past on a live account, or is trying out a new strategy, I've seen so many people do that, where they go, I'm going to try out a new strategy, I'm going to buy a new evaluation account, and I'm going to start a brand new strategy. I'm only going to trade that new strategy I've just learned on that evaluation account. I'm going to trade small. If you trade small and you have a negative edge, then you are significantly less likely to experience a move higher that would get you funded. And I like to look at this as the casino kind of problem. If you go into a casino and you've got $1,000 of risk, you lose that $1,000 and you're done, and your goal is to get to $1,500. If you go and put $5 every spin on black, you are not going to make $1,500 before you lose $1,000. You're just not. The odds are too far against you, and they're really not that bad, right? They're losing, but it's a pretty slow way of losing money. Now, on the other hand, which we're going to get into in a little bit, if you were to immediately put 750 down, or even just 500 down, then even though you're playing a losing game, you immediately, by putting, say you put 1,000 down, even easier, you put a whole $1,000 on one spin, there is a roundabout a 48% chance that you have $1,000 profit. And then if you then put $500 on the next spin, you've got another 48% chance that you're going to hit that target. So that means around about 24% of the time, you're going to be able to walk out the casino after 2 spins having made $1,500. Now, obviously, there is still a pretty good chance you're going to lose, but you're playing a losing game anyway. By sizing up, you gave yourself a minimum of 24% chance of becoming profitable over that very short period of time. And it's larger than that because obviously if you win the first spin and then lose 500 on the second, but then you might win 500 two in a row again. So you're probably looking at it being around about a 29, 30% an absolute guess. So you take something that's losing and give yourself a 30% chance of succeeding in. That's not too bad. Whereas if you put $5 in every spin, you're guaranteed to lose. So back to trading, if you have a slightly negative edge, if you trade with $50 per trade because you're less likely to fail, yes, you are less likely to blow the account inside of a week, but you are guaranteed to not pass the evaluation. You shouldn't gamble because if you get funded, you'll blow your account anyway. Completely agree with the statement, except for one critical thing. Just because you gamble, if you want to use that term, on an evaluation does not mean that you're going to gamble your funded account. Okay? The way I see the evaluations, this is exactly how I got funded, is I trade with huge size, knowing that I've still got an okay chance to get funded. They're cheap. I get funded, and then when I get my account, I will begin to strategize to make it less and less likely that I will hit the max drawdown. So gamble the evaluation, trade a little bit more professionally or with risk more at the focus once you become funded. And then the last one I see is don't rush. The whole point of the evaluation is to prove you're profitable. This is something that prop firms push as well. I'm going to say this. If you've not proved yourself as profitable before you get an evaluation account, you won't now suddenly become profitable. You prove that you're profitable before you put your money into the market, whether it's buying an evaluation account on your own account. If you don't do that, then you are essentially learning on the job. All you're doing is bleeding money. Prove that you can be a profitable trader beforehand and then use the evaluation to get the funds. You should not ever be using it to prove you're profitable. Now I've kind of touched on a lot of these topics, but bigger size is better because, as I just explained, even with a negative edge, you can get funded, right? If you simply go YOLO by go 2 minis long at the open on Monday on the Nasdaq rips 70 points in your favor. All of a sudden, it's like sweet. You've just made enough money in one trade to get funded on the 50k account, for example, with Bullnox. That strategy is not going to be something that you will make money with long term, but on that one trade, it was enough to get you funded. Now, if you have an edge, if you have put in the time to prove that you're profitable, you're coming from trading live money where you've made money before, why waste time proving that you're profitable? Realistically, you should be trying to get funded as quickly as possible so that you can then start making real money. Evaluations are cheap. Like I said, you can get most of them for like 50, 60, 70 bucks. Check out the link in the description down below to get the best deal that I can give on Bullnox right now. But you can also go around and look, see what Apex are offering, see what Top Step are offering. Look at all the different prop firms. Like, have a list of 5 or 6 that you think, yeah, this is fine, this is fine, this is fine. Which one is giving the best deal? Where is the best value for money right now? Use that to, pay as little as you can. If it costs 50 bucks, for example, 50 bucks and $70 reset, well, failing 3 times isn't the end of the world, right? If you hit it on your 4th go, right, you still only spend what, like 300 bucks or whatever, to then have access to $2,500 of risk. So they are cheap. And I've built a simulation, which I'm now going to show you, that really visualizes this well. So in this situation, this is going for the $50,000 Bullnox account. I've used their rules for this, the end of day drawdown rules, to be more specific. The max trailing drawdown is $2,500. That means that if you make $500, you do not have $3,000 of drawdown. You have $2,500 of drawdown. So it goes up. It's sort of your max profit is then, let's say at the end of day 1 you've made $500. Well, before you could go down to 47,500 or 47,500. Now you can go down to 48,000. If you are still a little bit confused, check out my videos on Bullnox, which explains that. And the profit target is $3,000. The strategy, the made-up strategy that I've just put in theoretically for numbers-wise is this one: you get 3 trades a day. The win percentage is 50% win, 50% lose, and the risk reward is 1 to 1.5. So that means that on this first strategy, or this first example we're going to use at $50 risk, When you have a losing trade, you lose 50. When you have a winning trade, you make 75. Now, this is a profitable strategy, and I've essentially created a random number generator to give us an idea of the potential outcome. We'll run this through a few times to see the differences, but we can see that the max drawdown didn't get anywhere near that 2,500, so that's cool. You know, trading small size, it didn't. At least we didn't hit that drawdown, but it did take a long time before we got funded. And in this particular run, even wow, that's kind of rare. Even after 120 days, it's a very bad run. A lot of pretty unfortunate compared to the other runs I've done. Didn't even get funded. If we run that again real quick, we can see in this run only a $325 drawdown, but we didn't get funded until day 48. Now there's 22 trading days in a month, so that means that you would have to go into month 3. So let's say you pay $50 for the initial evaluation. Well, you've now had to pay for 3 months worth. So you've essentially paid the same amount as somebody who blew their account 3 times. Okay. Now, the crazy thing is, and we'll go into this one a little bit more, if you'd have been taking $200 risk per trade and continued that strategy, in that same time, you would be up 12,200, which essentially means that you could have made $9,000 of real money in that time, just by taking the exact same trade but risking $200. Looking at that example now, we can see the max drawdown still got nowhere near 2,600, but we got funded on day 9. And if we run it again, you'll see often this happens where we get funded easily within the first 2 weeks, pretty much every single run that we do. And the max drawdown is mostly staying below the 2,600. This is the worst run I've seen this do ever, and it still got funded at the start of month 2. So you might look at this and say, okay, 80% of the time you get funded without having to reset or pay for the extra month. So that means that, you know, you want to get funded, well, 80% chance you only have to pay $50 for it. And there's the rest of the time you pay an extra $70 for it. Compare that to taking the $50 risk, same strategy, where it might take you an average of 3 or the 3rd month to get there. Well, you're paying more, and you're not being successful. You're not getting funded more, right? And the worst part is that you've actually missed out. And in this run here again, you could have made $8,000 or $9,000 of real money if you'd have been trading $200 on the real money account. And being completely honest, as we go through here, we can see the max drawdown. At no point we have a 3,300 drawdown here, but even that didn't happen until the account would have been seriously in profit. So you can even say, you know what? Once I'm funded, there's an 80% chance that even once I'm funded, I can probably build a buffer to get to that 2.5, 3K, so the max drawdown begins to increase, because once you hit $2,600 of profit, that max drawdown freezes at your starting amount. So if you get to $5,000, $6,000, $7,000 of profit before you have that 3K drawdown, well, you still have the account. Let's now move on to the $400 size, and we can begin to see that, again, we're almost always, if we get funded, it's going to be pretty early on, and we don't go through a big enough drawdown until we're up $32,000 after 2 months. We will go through bigger drawdowns with this size. It's inevitable, especially this edge isn't particularly huge. But if we just run a few more times, we'll be able to see that we're still likely to get funded. We didn't get funded this time. We failed the account. So that's 2 out of 3, 3 out of 4, 4 out of 5, 5 out of 6, 6 couldn't see it one, 6 out of 7, 7 out of 8, 8 out of 9, 9 out of 10. So you can see that there's probably still an 80% chance that you get funded before you go in a drawdown, or before you get funded before you have to reset the account. And you're going to get funded a lot quicker. And as we said, the difference is now pretty huge. If we take this run, which was a pretty good run, $50 risk, well, this one you didn't get funded until day 112. If you'd taken $400 worth of risk, you'd be up 24K at that point. And not only would be up 24K, you would not have had a drawdown big enough to blow your account, I don't think. Let's see. No, you wouldn't have done, because by the time you got 7,400, and you know, and then you had that drawdown of 3,400, you'd have been right on the cusp on this one, right on the cusp. So you might have blown the account, but that's a pretty unfortunate run. And even that one, you'd have still been up a lot. So bigger size makes sense. And then this one's kind of just for fun. This is an example of a strategy which is actually losing. It's a 33% win percentage and a risk reward of 2, so it's a break-even strategy. And this just goes to show that somebody who has a break-even strategy, they're still getting funded some of the time. On this instance, they got funded on day 2. Say someone who has a profitable strategy with the $50 risk, they don't get funded until day 57. So taking that larger size, even with a losing strategy, you can still get funded. And this is why bigger size is actually better. It makes you more likely to get funded. It increases your chances of getting funded. Now, there's always a tipping point, right? If you go so large with your risk that it's literally based on the trade. If you have a profitable edge, with a 33% win percentage, but you risk so much that you can get blown out in one trade, there's going to be a tipping point, obviously. But for the most part, what you'll find is that so long as your risk, and I think this is probably where you can begin using some gambling calculations out there, the Kelly criterion. You can go pretty big until you reach a point where you're better to go smaller. So that's just the math behind it. Jump back onto here. So my advice to doing this, because I don't want people to suddenly go, oh, I watched a guy on YouTube tell me that I don't know how to trade a strategy particularly well. I've never been a winning trader, but hey, I can just go huge size, and if it takes me 2 or 3 times, it doesn't matter because I'll have a funded account. True, but once you have that funded account, even if you size tiny, we're just going to lose that account anyway. So only only get an evaluation when you have an edge. Do not use them as practice or paper trading. Don't see it as this is a cheap way of, or this is a way I can just pay $50, and if I'm going to treat it like I'm paper trading, and if I hit the target, then I get the money. Don't look at it like that. Well, you are best to say, if you're looking at a new strategy, you're best to go, I'm going to backtest this strategy, and I'm going to get 50, 100, 150 examples. That might take you a month, maybe not even. This is the exact process I did. I backtested. I got, like 100 examples in the space of 2 weeks. Then I paper traded it, refined the strategy, and I paper traded / some very small live trading until I was at a point where I was like, yep, 100% certain that I have an edge here. The strategy I know is profitable. I'm trading at a level which is good enough. If you're interested in more detail on to do this, I have got a course called the Trading Blueprint. That's also in the links down below. It gives you essentially a guide to go from, I don't know what I'm doing, or I've got a brand new strategy, or I've just joined a chat room. It gives you a guide on how to get yourself ready to trade in a manner that means that by the time you begin trading, you are very certain to make money, and I'm going to create one specifically for prop firms as well. Once you're at a point where you've backtested your strategy, you know it works, you've paper traded, so you know that you are executing it at a good enough level, even if that takes you 2 months, it's still going to be quicker to then jump on an Eval account and trade $300, $400, $500 risk, whatever it may be, and get funded inside of 5 days than if you start trading today with $50 risk on the evaluation count. One, you're going to know you're profitable before you start, whereas if you just jump in now, you're just kind of guessing. And two, it's actually going to end up being cheaper for you anyway. So you're going to get funded quicker. You're going to pay less for it. So it's just a far better approach. And just a final thing here, look at the evaluations as a gateway to funds. Put in the work before them to know you're profitable, and then honestly, you could almost YOLO them. I've seen quite a few very successful prop firm traders who've come out and said that what they do is they take a trade that their strategy suggests, they take massive size, so they try to say, if it works out, I'm going to get funded in one trade or two trades, right? That's how I did it. I got funded my first account. I got funded on day 9. Second, I think I got funded on day 3, and third, I got funded in a day or something crazy like that. I can't remember the exact numbers now, but I've seen a lot of very successful prop firm traders do this, so that they then have the funds, and then they can immediately go, okay, now I've got the funds, I can trade with a little bit more caution, right? I'm going to, instead of taking massive size when you get the account, well, now I'm going to risk $100. Give myself 25 R. We even saw that you could go to $200 in that very small edge situation of 50-50 win percentage and 1 to 1.5 risk reward, and still have very low chance of blowing the account. So trading a more sensible number. And as I said, evaluations can cost $100 or less. Even if you only pass 1 in 3, you pay $300 for $2,500 risk. That's pretty decent going, right? Even if you pay $500 or $600 to get a 2.5K worth of risk, it's still cheaper than putting 2.5K in an account. And honestly, if you trade very small and you have to, it takes you a couple of months, you're going to pay that amount anyway. So you might as well do it, get funded a lot quicker, and have access to the money. I cannot stress enough, though, prove that you are profitable before getting an evaluation account. Prove it on paper, prove it through backtesting. Know 100% I am ready. And then when you get funded, you have those funds, you are ready to go, and you don't really have to have that panic of, do I have an edge or not?